Good morning, everybody. Thank you so much for joining us today for Coffee with Forethought, our February 2026 edition. Giving everybody a few minutes to join us here. Just as a reminder, as always, today is for informational purposes only. Jake and I are going to be covering a lot of information today. None of it is individualized financial advice, so you can see our website for full disclosures. And if you want to talk about your particular situation, let us know. One of our planners would be happy to dive in with you. Just give us a call and we're happy to do that. Also, as a reminder, we will once again be doing a live Q&A session at the end of our presentation today. So as we're going through this, there is a Q&A box at the very bottom of your screen in the floating panel there. Please feel free to click on that and type in your questions as we go along. That way you're not forgetting them. We're seeing them on our end, and we'll be prepared to answer as many as we can at the end of our presentation today. If for some reason Jake and I cannot get to your question, we will, of course, reach out and make sure that your question is still answered, even if we can't do it during the live Q&A. It's our favorite part of these presentations, so we highly encourage you to get involved and take advantage of that Q&A box at the bottom. Once again, Joel Johnson, Director of Planning here at FourThought, happy to be with you. And I am once again joined by Jake MacFarlane, our Senior Research Analyst. Jake, how you doing today?
Good morning, Joel. I'm doing good. It's a little cold, and myself, I'm coming off of a cold right now, so my voice is maybe about a 60% efficiency right now. So apologize if I go a little bit in and out, but it's always a pleasure to be here with you, Joel.
We will do our best, and I'm sure we'll do just fine. So here are our topics for today. So as always, our promise to you is we want to make this market driven. And so we are going to start with that. What has happened in the markets in the month of January, where we are year to date. We're going to touch on the economy. We want to check in on the Holy Grail and what our indicators are telling us. Are there any signs that we should be aware of or things to be watching as we start the new year? Earnings themes and investing fundamentals. We've already begun another earnings season. It's one of our favorite parts of the year. It's our company's way of telling us exactly how they're doing. It's their report cards. And so we're going through those. And so we'll be doing an update for you and then finishing up with some planning tips and tricks to get you started off on the right foot for the new year. And so let's dive right in and start with our hot start to 2026. Now, I say that kind of tongue in cheek because we actually did have a really hot start to the year pretty much across all of our indices here. So we've got the S&P 500, you've got the NASDAQ, the Dow Jones, and then, of course, our international index as well. We started the year great. We had quite a bit of bump in the middle there, and you see that our actual domestic markets actually took quite a bit of dive towards the middle of the month, and they didn't quite recover as we got to the end of the month. We were still positive for the start of the year. You've got the S&P there up about 1.5%, let's call it, rounding off. The Dow, which tends to be much more value oriented, actually did about 1.8%. So it was a slight outperformer. And you see the real big outperformer, once again, was actually the international markets. And this had been a theme for us all of last year. And it looks like we're starting off this year the same way. International is a place that you want to make sure you have an allocation. And Jake, I don't know if you have any thoughts on kind of what we saw in January, but I'm happy to see it. Good starts to the year are always better than the opposite.
Yeah, I think, one thing I'd point out, Joel, is everybody has to remember how these indices are constructed, right? And so especially for the NASDAQ and S&P 500, a lot of those indexes are kind of within still those big tech companies. And I think as the year started, those generally did pretty well. But then we kind of got into earnings season, and a couple of those big tech names reported over the last 2 weeks and start to see a little bit take shape there with how those markets have sort of come back a little bit. But to your point, in terms of international, I mean, there are some true thematic investment themes in the international markets in terms of Germany's defense spending and kind of their industrial revolution that's kind of taking shape. I mean, there's a lot of reasons to be excited about international, and it's a key theme for us internally here too.
Absolutely. It's one of the conversations we've been having. We will continue to have. I will give a quick word of caution because we see it time and time again when you see this outperformance over an extended period of time, chasing performance. Please do not do that. We want to make sure that your allocation is the right size, but we do not want to be chasing that performance. We want to be there, but just don't be over allocating. Just because it has done well, past performance does not guarantee future results. So just a quick word of caution there, especially pertaining to international, but I agree, definitely a key theme running into 2026. And this is also a good time for me to mention, and I will at the end as well. Jake's also going to be doing our full economic webinar in just a couple of weeks with Scott Pinkerton. So please keep an eye out for those invitations and make sure you join us for that, where they get to dive a little bit deeper into what those other key themes might be as well. So switching gears quickly to look at the bonds, the bond market, our treasury yield curve here. You see that we have had quite a bit of movement, especially on the short end. This is all compared to a year ago. The year ago is that top line that you see there in the gold, let's call it. Today is in the blue. Not much movement over the last month or so, which is good news. One of the biggest headlines that we've seen thus far this year was the announcement of the new potential Fed chair once Jerome Powell steps down. That was expected to come. It was one of the things we were keeping an eye on. Thus far, that has not seemed to have spooked the markets or changed it in any way. There, of course, is the headlines about Fed independence and such. We are keeping an eye on it. We do not see that there will be any overreach from into the Federal Reserve. They will continue to do their job well, and that's what the bond market is telling us as well. This is a very good weighing machine for headlines like that. So this is where we're keeping an eye on things, and we'll keep you updated as that kind of continues to evolve. But for now, the general consensus seems to be that we're in a holding pattern for rates. We're going to look at why when we get to the economic indicators in just a second. That could potentially change mid to the end of the year. But again, hopefully that continues to be numbers driven and not just feelings about the economy. Because once we dive into these numbers, I think some people are going to be a little shocked. But Jake, anything to add there about our bond market?
I really couldn't agree with you more. I think there's a true disconnect between maybe some of the headlines, right, which are a little bit more scary than kind of what the yield curve is suggesting right now. Yeah, I think if we really started to see some cracks there in terms of independence or objectivity with what the Fed is able to do, kind of with the next chairman who kind of gets in there, I think we'd start to see a little bit more happen with the yield curve. But kind of putting that aside, when I look at this current yield curve, I see a much healthier one than what we've sort of been used to over really the last. It's been a while, but typically you would expect the longer term rates to be higher than the shorter term rates, and to sort of have a moderately upward sloping yield curve. I think we're getting there. But to your point, Joel, it's sort of a wait and see approach at this point.
Yeah, that's actually a great point. And what Jake's talking about there is exactly this. And we call it kind of the 10-2 split is typically what we're looking at here. And it's a great segue into our economic indicator discussion here. And one of those is the yield curve. So the difference between what you're getting paid on a 10-year bond versus what you're getting paid on a 2-year bond. And that's right there in the middle of our curve here. And you see that that's actually right now at 72 bips, basis points. Bips is what we call it, but basis points. So that is a much healthier curve or much healthier difference. Just like Jay said, that's what you would expect. Compared to a year ago, that difference was only 20 basis points. So it's moving in the right direction. One of the things you might start hearing, hopefully not, because again, we're in a healthy, and ironically, this time when we had kind of the 10 and the 2 that were pretty close to together, one of the things that all the people on the talking heads on TV talk about is how that's an indicator of a recession. I really didn't hear that much this time around, which was actually good because that isn't a true indicator of a recession. It doesn't always happen that way. So I was glad to see them kind of focus on other things. But if we start to see that reverse at all, just be aware that that's one of the things that they're going to bring up. Again, I was happy to not hear it because, frankly, it's a little overdone in my opinion. But a healthier yield curve is certainly good for the overall markets. Then I think everybody's going to have their attention drawn to that top line there, our housing starts number. So that is down from 1 year ago. You see that it's down about 8%. And I think a lot of that is probably driven because of interest rates. So all of these home builders and the people that are trying to build the supply in the housing market, they aren't really great forecasters, it seems like. And so when we've had these high interest rates, they were really struggling to get their product, which is new homes, to the market because people weren't able to afford them. Housing affordability, of course, continues to be a big issue. You've seen rates come down. I think the 30-year mortgage is just over 6% now versus a year ago it was closer to around 7. So that's good news for the housing market. So we may start to see this swing back. But right now, that is showing as a red in our green, yellow, red system here of something to keep an eye on. We're not making any major changes to portfolios because of it. Again, the consumer might actually be benefiting from those lower rates. We're going to continue to keep an eye on it and see how the market's moving it with housing. But overall, that's the kind of the one that sticks out to me, obviously, because it's the only red we have. But Jake, what other indicators are you looking at on this chart that stand out to you?
Yeah, that's really well said, Joel. When I look at this too, I think about, maybe what the Fed is looking to do with some of all the plethora of data they get on the economy. We kind of take it back to the basics. They sort of have a dual mandate of keeping pretty steady employment and then also relatively stable prices. And so the two that I will look at here that kind of speak to that would be the labor market. Right now, we see an unemployment rate right around 4.4%. Now, with the little shutdown, we are still trying to work through and getting data from sort of a missing month or two. However, if we look at that versus a year ago, is at 4%. So it's climbed up a little bit, and we've seen the Fed adjust by starting to take rates down, and that's sort of one mechanism that they use. Looking at the other mandate would be stable prices. And we've seen inflation come down. However, we're still riding above the Fed's stated 2% target. And it's been sticky around this range for the last couple of quarters now. And so I think what the Fed is doing is, they really want to be data driven, data dependent. And they're sort of seeing that, hey, prices are getting a little bit sticky. We don't want to reduce rates and sort of stimulate right now because that might heat inflation back up. However, they're sort of monitoring the employment data as well as that's crept up, but it hasn't gotten to kind of an unruly state yet. And we're at kind of a spot here where if we look at wage growth and even wage growth adjusted for inflation, we're still in a positive territory. And so I think a wait and see approach makes sense right now. And then there's a lot of uncertainty with sort of who takes the throne, so to say, once Jerome Powell steps down. So really, a couple items to look at there. I also look at retail sales as well. I mean, at the end of the day, our economy is very heavily consumption driven. Almost 2/3 of our GDP comes from consumption. And so looking at how the consumer behavior is taking shape, we're still in a pretty healthy market right now. And we've seen GDP growth print pretty strong there. So I would say maybe a slower growth, but still an economy with growth, inflation that's coming down, and an unemployment rate that it has ticked up, but is not, really raising any red alerts right now.
Yeah, very, could not agree with you more. I think it's going to be an interesting year from an economic standpoint because when we're lowering interest rates or really raising them too, the effect for that to really show up in these numbers typically takes 3 to 6 months. It's not an immediate thing, right? So wait and hold makes perfect sense with what we're seeing right now. Uh, you talked about the labor market. I think that's going to be a really interesting data point because we might be getting into a situation where an uptick in unemployment is not market driven or it's not financially driven, that an increase in rates or anything. The Fed may not have any control over that because of the introduction of AI and how efficient these companies are becoming and introducing it. So we may be getting some short-term disjointed unemployment from something that the Fed is not going to have any control over. So it's going to be interesting to see what that might look like as we go into 2026. Just wanted to touch on that as you were talking. I kind of thought about that. So but great points. So good economy, strong overall. Jake and I really wanted to make sure that we spend some time today on what I have been hearing day in and day out from all of my clients, which is about commodities. And Jake, I'll let you kind of kick this one off because this was on your list of favorite topics to talk about today. But kind of tell us what gold and silver have been doing and kind of why people are talking about it so much.
Yeah, absolutely. And this is a really great chart here that shows the change, right, in gold and silver prices versus the S&P 500. And as investors who are sort of paying attention to what the market's done over the last 8 to 10 years, S&P 500 has been pretty darn difficult to beat, right, Joel? And as we look here, a couple of things that have beaten it are gold and silver. And I guess, well, gold is not quite there yet. However, I mean, it's gotten to be something that people talk about all the time, in good years, in bad years. It's gold and silver are things that have a lot to do with confidence in the market. They're sort of seen as a safe haven, as inflation protection assets. And so when consumer confidence is down, investor sentiment is down, a lot of times you'll start to see maybe a little rally from gold and silver, but certainly not to the extent we've seen over the last couple of years. I think what's important to note is that even though inflation has come down from its peak, it's stayed higher than many have expected. And that matters a lot for precious metals that are sort of seen as a natural inflation hedge. However, it's also important to note that gold and silver care less about today's inflation print, and they care more about confidence in monetary policy over time. And at the end of the day, like a lot of stocks and bonds are, it's a matter of supply and demand. And what we've seen is that the demand for gold and silver, especially as I look at central banks within like emerging markets, I mean, they've been buying gold at historically high levels over the last few years. So that coupled with broader geopolitical risk, I mean, this is a hedge against unknown outcomes and not even just market volatility. Now, to take a quick step back, when looking at just silver, it is important to note it's not just a monetary metal, and it is an industrial one. And we've talked a lot about kind of the shifting in supply chains that COVID brought forth. I mean, it was a standpoint where you could just outsource everything and almost have certainty that everything's going to be okay. COVID really flipped that script. And we've seen a lot of businesses, talk about nearshoring or onshoring, at the very least, having some redundancies within supply chain. And so as we look at that industrial upkeep, even from, thinking about the power demand that AI is going to represent, I mean, these are all things that are beneficial to silver as more of an industrial metal than even just a monetary one. Joe, I'll pause there. I talked a lot, and I was curious to get your view on this as well.
No, I think you did a great job of summing it up. But the thing I'll point out for this chart here is you'll notice going back over 10 years, it had underperformed both gold and silver for quite a bit of that period of time. And it's really been this increase in AI, also with the tariff conversation, the geopolitical risk. That's really where we've seen this huge uptick in performance that ended up outpacing the S&P 500 over that 10-year period. It has not been the entire time. And so that's a really good opportunity for us to pan out and kind of look at over the long term what has actually happened with gold and silver. And this is the chart that leads most financial advisors to say, no, it's really not a great part of your traditional portfolio because stocks over the long term tend to outperform gold and silver, but gold and silver tend to outperform in times of fear. And you can go down the list, and every financial advisor has the same script. But this is why, is because the gold and the silver are commodities. They are worth what somebody else is willing to pay for it. And in times of fear, people are willing to pay more for it because of uncertainty and other aspects that Jake just did a great job of explaining. So you see, going all the way back to the 80s, even a little bit before, gold and silver have done just fine. And they have increased in value. That's a supply and demand thing. People are willing to pay more for it today. But if you compare that to the S&P 500 over that same time period, you can see the vast outperformance primarily because the S&P is not a commodity. It's not what somebody else is willing to pay for it. There's an element of that, but we actually own companies, and these companies are generating earnings, and there's something that we can tie our flag to that says this is what this company's value is. And it's not just a feeling between a buyer and a seller. It is actually what those companies are generating in revenue and earnings. And again, fundamental analysis would lead you to believe that over the long term, it's done well, and it has. And so the caution for me as a financial advisor is, again, don't chase the performance here. Gold and silver can make a portion of your portfolio if you own it for the right reasons. And from there, it becomes an asset allocation decision that we walk clients through all the time. But by default, they tend to not end up in our portfolios because we want that long-term performance. We want to have something that we can analyze and say we know what that is worth, and not just rely on a market that is very temperamental, as we've seen over the last couple of months that wasn't shown in that chart, and big volatile spikes in gold and silver prices. But it doesn't mean it can't be a part of your portfolio. It just means it needs to have a deeper conversation.
Yeah, and Joel, just to kind of opine on that too, and the chart doesn't do it justice because I think what we ended it at the end of October of 2025. But for example, in the last 5 days, silver's down about 22% now. So not to say, hey, told you so or anything like that, but just the nature of the beast is that it is volatile, especially when it's highly traded. And right now, it's being highly traded. Most of the trade activity has been buyers, right? And that's where we've seen the run up in price. And Joel, I think to your point is so true. As fundamental investors, we're looking at entities that have assets, and those assets can generate a return that's above their cost of capital. You know, a business that whether they're with an AI or an industrial company, you know, it's not just worth what somebody deems it. They actually have tangible assets. Sometimes they have intangible assets. But at the end of the day, we're looking at companies that have growth. And it's one thing that to say, hey, be careful about a stock that's done well. Don't just chase the performance. That performance could be driven organically by profits that are increasing, and the value of that business might have tangibly risen. For gold and silver, it's harder to make that case because at the end of the day, those assets aren't producing, you know, they aren't producing any revenue, any profits or anything. It is truly just worth what somebody else is willing to pay for it. And there's no, you know, sort of tangible value that can be assigned because of assets that the entity owns. So that's where I couldn't agree with you more, Joel. I view it a lot more as a hedge, and whether you know you want to have hedges in your portfolio to either add value when maybe other asset classes aren't doing so well, then that's an asset allocation decision, and it should be based less on you know how that asset class has done recently. And I think that's what you know what we're trying to build here at FourThought as well.
You know, we didn't go into today's presentation with a theme, but we should have, and the theme should have been don't chase performance. So take that for what you will. But speaking of, let's kind of keep the train going there, and let's start talking about some of the earnings that we've seen so far. I know it's been a heavy earnings season already. Big names reported last week. Jake, I'll let you kick us off here. Tell us kind of what we've been seeing and what these report cards have been telling us.
Yeah, I'm happy to. I think the top two names are household ones that sort of everybody knows, right? Microsoft, and actually, it's funny. They're almost like the tale of two cities here with how they reacted post earnings. So Microsoft had earnings a couple weeks ago. Very, very strong results based on the profits that they generated and the revenue. Both exceeded the expectations that the company had and that analysts had. However, the stock was down 7% after those earnings. So you have to kind of dig into maybe what went wrong or what didn't maybe go as well. And a lot of it has to do with the guidance that they gave, especially around Azure, which is their cloud platform. It was sort of deemed a quote unquote lackluster beat, which means it beat expectations, but not to the true expectations that the market sort of demanded. And the other thing too is that they guided that they were going to continue to increase their capital expenditures. And what investors kind of in retrospect hope to see was maybe a reduction or maybe maintaining the level of capital expenditures and maybe some faster cloud or AI monetization, which sort of fell short a little bit. But if you look at kind of what Wall Street analysts who cover Microsoft and have covered the company for years and years, they seem pretty unwavered in what their fair value of Microsoft was kind of after earnings. So to me, that does sort of exude a little bit of confidence there that hey, the stock was down pretty big, and if you own Microsoft and were watching it that day, you might have been a little bit flustered, but the fundamentals are still pretty much intact, which obviously gives us confidence. The other stock here, Meta Platforms, again had a very strong profit and revenue beat, and the shares were up 9% post earnings. So if we look here, kind of a similar profile to Microsoft in terms of the growth over the quarter and over the last year, very strong results. But as we look forward, the guidance for Meta was a little bit more formidable. And what's really important here is we look at daily active users who are on Facebook and on Instagram, a lot of their household platforms. That was up over 7%, and they're expecting continued growth there. And also advertising and impressions. I mean, that's a huge business of Meta is the advertisements. And they saw year over year impression increase by 18%. So that flywheel is still spinning very nicely for Meta. And as a result, investors certainly rewarded that company. Now, getting into the next two companies, so KLA Corporation. I think anyone who's followed the markets over the last few years is familiar with kind of the massive gains we've seen within semiconductors. Names like NVIDIA, Broadcom, AMD, these companies have become almost synonyms with kind of AI and overall data center growth. What's interesting is that some of the most important companies in that ecosystem are not household names at all. They don't design the chips and they don't make the GPUs per se, but without them, these chips do not get made. And they're sort of like the pickaxe and shovels, I think, to the overall semiconductor ecosystem. KLA is certainly one of those companies, and it's flown under the radar historically. But recently, the stock's gone on a strong run as investors really started to appreciate how critical its role is. And so a lot of people might not know, but at a high level, what KLA does is they make the tools that semiconductor manufacturers can use to inspect and measure and kind of do quality control on the chips that are being made. It's important because modern chips are built layer by layer at the atomic level. And if there's a defect, that's going to be invisible to the human eye or even to like traditional equipment, and it can ruin the entire chip. And that chip might be reproduced, millions of times, and can be a huge error and financial impact to these design companies and chip manufacturers. And so if you can think of NVIDIA as the company that's sort of designing the Formula One car, maybe a company like TSM is building the Formula One car, and KLA Corporation is the high precision inspection system that makes sure every single component is perfect before it actually, the car actually leaves the factory. And so, again, this is a company that sort of fell behind a little bit. However, over the last year, if we look at calendar year 2025, KLA Corp almost doubled in terms of stock price. It was up about 93%. And the stock's up another 18% this year. When I look at the earnings here for KLA Corp, that context really matters. And the result of the earnings were shares that were down about 15%. When I dig through them, it's clear to me that, again, the fundamentals are still very strong, but perhaps the valuation got a little bit ahead of itself. And so, again, when we talk about, hey, don't just chase performance, because that's potentially what could happen is you sort of, fear of missing out or FOMO into a company, and they have results that are good but not perfect, and the stock's heavily punished thereafter. So I think for us, long term, we still really like the company. However, just again another tale here of caution with these stocks that have great businesses, but the stock price has just gotten a little bit out of hand. And then the last company I'll mention here would be Air Products. Air Products and Chemicals trades under the ticker APD. Again, maybe one that you might not have heard of before, but they're a global industrial gas and chemicals companies. They produce and supply atmospheric gases. These are like oxygen, nitrogen, etc., to different and also equipment to a wide range of industries worldwide. Air Products had a pretty tough go in 2025. The market was up. Air Products was down about 10% or so. But it started this year off pretty strong. It's up about 11%, which, as we looked at how the S&P 500 is doing, it's obviously outpaced that by multiples. We look at the earnings here; they were positive, and profits were basically in line with expectations. And again, as we look at this, if Microsoft or Meta, had an earnings where the results were fine, they were in line, they would be punished because the market is expecting this growth to really come in. With Air Products, the expectations were certainly lower. And so when they have a quarter where they do good, strong earnings, strong profits, but not great, they were actually rewarded because the market feared it would be a little bit worse. So I think, with these four companies, some are similar. Certainly, we had a whole range of reaction to earnings, and really, what I'm paying attention to is: are these companies able to organically grow, or are they having to maybe do some financial engineering, trying to maybe buy growth or raise additional debt? I haven't seen that yet, and so far, growth has certainly held in there.
Great synopsis on four great companies there. That I just wanted to quickly go back and just talk about KLA Corp. And you hit on it a little bit, but the technology and the specification of the actual fabrication of chips, when you start digging into that, the precision that this technology has to have across the board is incredible. And so one of the themes or one of the things that we always look for in companies is what we call a moat. And you'll hear us talk about this all the time, but how likely is it that some other competitor is going to be able to come in and start competing in that space? There's so many of these companies, like you were talking about, Jake, that aren't household names, that is a wide moat, and it all comes down to the technology. So we keep talking about the investments and such, but the ramp up to start competing there is just incredible. But thank you for the update there. I'm sure we'll be doing more of that at our next one and have some more report cards coming out and keep everybody updated on those themes there. So jumping over, one of the things that Jake and I wanted to make sure we talked about today was time in the market versus timing the market. And so, Jake, I'll throw it back to you again. This is your chart here, and I know it's one of your favorites. So why don't you kick us off on the discussion?
Yeah, what this chart does, I'll try to explain it a little bit first, is if you put $1 into the market today, what this looks at is different time frames, and it looks at the probability or the frequency that you had positive returns after some period of time. So on the left-hand side, sort of those first two bars, you have 1 day. So the frequency of positive returns is about a coin flip. If you put $1 in today, invested it, and checked it again tomorrow, not good, not terrible. It's about a 50-50. But as your time period, as your investment horizon expands, a week, a month to a year, 3 years, 5 years, that frequency of positive returns gets higher and higher, sort of approaches 100%. Now, the two different bars are important as well. The green one is a diversified portfolio, 60% in stocks, 40% in bonds. And the gray is an all stock portfolio. And you can see they pretty much tag along until we get to the longer years, 3 years, 5 years, 10 years out. And it sort of shows that, a well-balanced portfolio increases your odds, let's say, or increases the frequency that we've seen historically that you'll have positive returns over, a 3 year, a 5 year, and a 10-year rolling period. And so to me, this truly shows the idea that the time in the market is so much more important than timing the market, because in the short term it's so tough to make those predictions. It's almost impossible. And there's a lot of different data points that we can see that show this of trying to trade the market, getting fully in versus fully out. It's a losing game over time, and it really requires you to be right twice, when to get out and then when to get back in. And a lot of times, if you're only using headlines to inform your sort of opinion on that, and the market's forward looking, there's just a conflict there, and it at the end of the day it just doesn't work. So, Joel, I thought this was an important one to look at.
Yeah, and I think it's timely, kind of playing on words there. But and the reason is because, again, something we've been talking about, every talking head has been talking about, is the valuation on the market, and it's high. And you've heard predictions about how over the next 10 years the S&P is going to be flat and so on and so forth. And we've done the same analysis. We know where those numbers are coming from, but what that means is there will potentially be a pullback at some point. That's actually healthy for a market. We've been trying to encourage our clients to just be prepared for that mentally. But every single time that happens, every single time we see just a few days worth of down performance, everybody, Jake and I included, has a tendency to say, this time is different. I need to get out because I know that this time is different, and I need to time this market. I know that this is going to be bad. This is a great chart to show that hanging in there through those times, talking to your financial planner, advisor, whoever it is, to keep you on track with your long-term plan works in the long run. Another one that we show all the time, right, is that missing the best 10 days and so on and so forth. Every piece of research says the same thing. Buying, holding, staying invested is the best thing that you can do for your portfolio. And so when that time comes, pick up the phone, give us a call, and let us walk you through that. But I think this is a good way to roll into the second thing that we wanted to talk about, which was portfolio drift. And again, Jake, I'll throw it over to you to lead this discussion, but especially with what we've seen as far as overperformers versus just market performers over the last couple of years, very good conversation to be had here.
Yeah, I think you use the term, buy and hold, and it's so true. It's so important that what you're meaning by that is you have an allocation and you want to stay true to that allocation. You want to hold on to that. You don't want to take big swings and go from, a balanced portfolio fully into cash, right? What's important though is you don't necessarily have to just hold the same stocks or basket of stocks, right? You can rebalance within those asset classes and maintain your overall asset allocation. And that's truly important. And this slide, what it shows is if you had a portfolio of 60% equities, 40% bonds going back about 5 years ago, what that would look like if you didn't do any rebalancing within the portfolio. It would have gradually transitioned to over 70% in stocks and under 30% in bonds. And what that means, obviously, we know that the stock market, it should outpace bonds over time. It's bonds are less risky and therefore should have a lower expected return than stocks. But what this does, if you hold on to your darling winners, even that can materially impact the risk profile that you are taking. And in this case, what we see and what we fear is that portfolios are maybe a little bit more aggressive than they should be because of an unwillingness to rebalance. And we're going to talk about from a tax situation. A lot of times that is a big burden. There is nobody, wants to willingly pay Uncle Sam, right? You want to keep your hard-earned money, and with stocks that you've done really, really well in, you don't want to pay a lot of taxes in that. But putting that to the side, a lot of times it's really more about like, I just love this company, and I couldn't see a future where company XYZ, isn't important and it's done so well. And that is a bias there that number one, it's an overconfidence. But number two, it is an expectation that what happened in the past, what you're used to, will just continue to happen. And again, it's kind of our job here to look at it holistically and say, hey, that's a risk. We need to dial this down and we need to do some rebalancing.
Yeah, yeah, absolutely. And that's a great setup for me to kind of spike this one home with our favorite saying when it comes to planning and investment portfolios, which is don't let the tax tail wag the dog. What we mean by that is everything Jake just talked about. You have all these biases about the portfolio. You have all of these companies that have done great, and we just want to hang on because it just hurts writing that tax bill in April. We have to do it again in a few months. I hate it too. But you really have to understand kind of what you're giving up just to avoid the taxes when you're making that decision. So one of the things that all of our planners here do is what we call a tax budget with our clients. And what that is, everything that we do as planners, everything that we do with investments, everything at some point touches taxes. And so we want to make sure that we're on the same page with our clients about what that tax liability might look like. And then that allows us to really customize our management of their portfolio to their specific situation. It's very important that we have those conversations. And if your advisor is not a FourThought advisor and they're not having that conversation with you, please let us know. We'd be happy to do it and kind of show you the benefits of doing that ahead of time rather than waiting to get to December 31st and realizing that you've got a big issue that you're now going to have to deal with just 4 months later. The second thing there, Jake hit on it again, is do you need to rebalance? Probably the answer is yes. Equities have had a significant run of outperformance over the last 5, really 10 years as compared to fixed income. It's time to take a look at your overall allocation, make sure that you're appropriately lined for your risk tolerance, because what's happened in the past is not going to be the same that happens in the future. We need to make sure that you're set up for success to get to that future the easiest way possible without too much stress. The risks lurking in your portfolio. This is something I really wanted to make sure we touched on just briefly, which is, do you understand what you actually own? Index funds and owning just the index has become very popular. It's a good strategy for some clients, but that is an allocation decision. So if you own a 10% position in NVIDIA outside of an index fund, and then you've also got an account with 100% in the index fund, now you're over allocated in NVIDIA because you've got it over here inside of the index fund and you've got it over here. So you want to make sure that your total allocation to these stocks runs the gamut, is just understanding what you own and making sure that you're making the allocation decisions that are right for you, and making sure that you don't have anything lurking in your portfolio that might shock you one day that you just weren't aware of. So we do that analysis all the time, and we talk through it with clients and make sure that they understand what's happening. Again, you are unique, and so your plan should be too. And so that kind of goes back to the tax budget and all of these things. And Jake, even to your biases, as if you do have a bias, let's work around those. It's not saying that we have to sell that position in NVIDIA. It's just, what do we need to do to compensate for it if you really want to let the tax tail wag the dog? Okay, but now we need to make other decisions. So you need to make sure that you're taking into that holistic planning process, that we're looking at all those risks and accounting for them appropriately. And then finally, tax season is upon us again. You're probably getting all your tax documents. You're getting those over to your CPA or tax professional. We're here to help you any way that we possibly can. I know that we custody with Fidelity. They're preparing their tax forms right now. I think the last I saw was they're hopefully going to have all of them out by the end of February. But if we can do anything to make your life easier as you prepare for your tax season, please let us know. And we're going to get through this April and then right back at it and planning for next one already. So a lot of things to be doing in the new year already. But again, the big tagline there, please do not let the tax tail wag the dog. It will eventually come back to bite you. So with that, Jake, any last words here?
No, I mean, I think, beginning of the year is a great time to look at this. And in one instance, you have sort of the whole year to do some tax loss harvesting to hopefully, sort of offset any gains that were taken as well. And so these are, things that we do here at FourThought. We're frequently looking at opportunities to do some tax loss harvesting within our portfolios. But couldn't agree more with everything that you said here, Joel.
All right. And with that, thank you everybody for joining us. We are going to flip on over to our live Q&A. Jake and I will stay as long as we can to get your questions answered. As always, if there's anybody that you think would benefit from hearing these conversations, we do this every single month, first Thursday of the month, and we would love to have them join us. And if we have more questions that we weren't able to get to today, please give us a call. We are happy to talk through your specific situation and see if we can help you out. So let's jump on over to the Q&A and see what kind of questions we got today.
All right, all right. It looks like we've got a couple questions that came in here live. So Joel, I'll kind of tee the first one up to you here, and it's about predicted fall in prices within technology, maybe semiconductors, software, and maybe how that could trickle down into affecting index funds or different ETFs.
Yeah, it's a fantastic question. It's one we touched briefly on that last slide, which is, do you understand what you own? Right now, inside of the index, there are six stocks that make up over 30% of the index. We just did the math. And I'm going to create a new acronym today. We're going to change it over to MAGMAN from, you remember FANG back in the day. But those are the top six names, which are you got Microsoft, you've got Amazon, Google, Meta, Broadcom, which their ticker starts with an A, and then of course Nvidia being the big dog in that race as well. So those six stocks, 30% of the portfolio, and what we're talking about here really is their valuation. They are high if you look relative to the S&P 500 previously, and really even their valuations over the longer term. But like we talked about, if they continue to grow, that doesn't necessarily mean that they will see any price drops, although we don't are not in the job of predictions here. So what that all means really for an index fund is that if you do see a pullback in AI stocks, we're starting to potentially see that today's a down day. You're going to be affected. You've got 30% that are all very heavily tied to that AI trade. But what we're not talking about with that analysis is the other 70% of the index, which does not have that same effect. And so you will have some offsetting with the other 494 names that are in the S&P 500, which are at actually pretty decent values across the board when you actually look at their valuations relative to those top six names. It's just all comes down to how that index is constructed. But again, you will have a significant, they drive the S&P 500 for the most part, even if those other 494 names don't get hurt nearly as badly. It's something you need to keep an eye on and be aware of, and that's one of those lurking dangers potentially inside of your portfolio. So Jake, I don't know if you have anything else to add to that.
Yeah, I mean, I was just in my notebook here this morning. I found it interesting. We've already kind of started to see this take shape in the last couple days. For example, in the last 5 days, the S&P 500, kind of the most popular index fund, right, down almost 1%. But if you look at the different sectors, there's a technology sector ETF that you could purchase that was down 4%, right, in that last 5 days. However, you can compare that with the dividend index. So a dividend growth ETF that we kind of commonly look at, DGRO is the ticker there. And that was up 1.7% in the last 5 days. So it's highly dependent about, what index you own or what index fund you own. I think, to your point, Joel, knowing what you own is extremely important. And that's the whole sort of debate between an active manager who is looking at either specific companies to invest in or specific maybe factors to look at, maybe quality or dividend factors, versus just a pure passive index, which at the end of the day has different rules that they follow. S&P 500, for example, just the 500 largest companies in the US, and it's market cap weighted. So the larger companies take up more of that share. And right now it's very highly concentrated into those mostly big tech names. So yeah, I think it's certainly something that we're keeping our eye on. But to your point, Joel, if you only look at that and where kind of the index is moving, you're basically ignoring maybe the other 495, right, companies that are within US and are in a great economy that just maybe aren't as big.
Yeah. Yeah, absolutely. And speaking of what you own, so hopefully that did a good job of answering the question. If you want to dive in deeper, more than happy to. But speaking of knowing what you own, we touched on gold and silver, and one of the tangential plays that you can look at, of course, is miners. And Jake, what are your thoughts on the actual miners rather than owning the actual commodity itself?
Yeah, it's a great question. You can look at a lot of folks look at, hey, I'll own the miner as kind of like a proxy for owning the underlying commodity that's being produced. So you have gold miners, copper miners, silver miners, etc. And the thing with that is the largest driver of revenue for those companies is the commodity price, right? So it is highly linked to the commodity prices where I think there is some deviation, right? It's not perfect correlation or anything like that, is that these businesses have operational leverage. And what that means, especially within the miners, is they have an enormous amount of fixed cost. So no matter if gold is very, very attractive in terms of the pricing or it's kind of down in the dumps, it still costs them, 90% or however percentage it is, they can pencil in what it's going to cost them to sort of operate. So what that means is, when gold goes up in value, their margins can increase, and it can actually lead to the miners doing better than the underlying price can. There's also risks associated with operational leverage and just stocks in general, which at the end of the day, you're looking at buying equity into one of these mining companies. So there's a lot of issues within kind of the cost structure as well as balance sheets. Generally speaking, these miners tend to operate with a high amount of debt, and so when we look at the balance sheet, it's oftentimes a little bit of a sticky force for us to look past because it brings on a lot more leverage, brings on a lot more risk, as we all know. But also, what's a little bit different than just the commodity price itself is you have all of these like stock specific risk factors. Interest rates can at some point drive sort of how a stock is valued, and that's a little bit separated from maybe a driver that would influence the underlying commodity price. And at the end of the day, there's country and there's political risk with where these miners set up their operations. So it's not just as simple as saying, hey, if you want to take on this hedge, just buy one of the miners. Definitely a little bit more to it, and that's again more of an asset allocation decision from our framework on, do you want to have this asset class represented in your portfolio as more of a hedge? And I think our opinion, at least my opinion, Joel, and if you disagree, let me know, but would be, if you want to have that exposure, I would say do it through maybe an ETF that just tracks the sort of underlying commodity price there. That in my opinion is kind of the most pure way to get that hedge.
No, I think you said it well. I think that's a great place to leave us today. We ran a little bit over our time. We tried to keep to about 45 minutes, ran a little long today, but a lot of great information. Hopefully you found it helpful. Thank you for the questions. We will, of course, be doing this again next month, so please remember to join us again then. Again, any questions that you might have, you want to make sure that we reach out or you reach out to us. We're happy to answer those for you. But everybody, please enjoy your weekend, and we'll look forward to seeing you again next month. Thank you all.
Take care.